This is Commodity Wrap. I'm Tony St. James. Midwest Market Solutions. It's where you'll find our next guest. He's the president of Midwest Market Solutions. Online, MidwestMarketSolutions.com. I don't think I can say Midwest Market Solutions one more time there. I think I've hit the limit. Brian Hoops, great to have you back.
Yeah, it's a great introduction. You said the company name several times. You know, that way people remember it for sure.
Yeah. Okay. Interesting. I every day seems to be a little more interesting to me. You know, I guess I'd gotten lulled into a slumber, if you will, back with the trade through November, December, and really till we got a WASDE report in January. And, you know, we had that big drop-off, and then we started rallying the markets. And it looked like we were doing pretty good, and then something happened, and the train has derailed here. The corn market, we're not really looking any longer at that $5 mark. That seems to be in the rearview mirror. Maybe another chance to run back at it. But on Wednesday, December corn settled 4.5 lower, 477.5. We did see November beans kind of holding steady, penny and a quarter higher, 1181.5. Some strength there in both soy meal and bean oil. And I'll stop there because these are the markets that aren't just rocketing one way or the other. But when you look at corn and beans, what's happening here?
Well, I think we're obviously taking some premium out of the market here. You know, you mentioned we were down 4.5 in corn. It's the lowest close since all the way back on April the 20th that we had. So we've erased, 5 weeks of gains for the most part here in corn. And, I think there's a lot of psychological type selling coming into the market where you saw $5 December corn, $12 November beans. And, it's a far cry from what we were picturing back in January after that supply and demand report that you talked about. We closed that day about $4.50 on December corn. And I think there was a lot of producers that said, boy, if we ever get some sort of a rally back up into, where I can sell cash for $4.50 or something like that, corn gets back to $4.80 or $4.90, I'm going to make some sales. And lo and behold, we went from that $4.50 up to $5.05. We went from soybeans from $10.60 to over $12. So, producers were justified in making some movement of merchandising product there. And not everybody made 100% sales, but there was a lot of cash sales being made, a lot of options purchased, whether those were puts to cover the remaining portion that didn't get sold, or maybe even some call options to cover the cash sales that were made at $5 to give, look at the summer growing season. But a lot of activity was done. A lot of merchandising was done from producers with old crop and new crop. And I think that was certainly the right thing to do because we had such a sizable rally. And a lot of it was predicated on what was happening between the U.S. and Iran and fertilizer prices and energy prices moving higher. And we didn't think they would stay there. We don't, nobody knew when the war would end, but we didn't think by harvest time these high prices for corn and soybeans would be still there. They would be artificially inflated as the war would probably come to an end. And so now it looks like we're getting closer to that war coming to an end. We're starting to remove some premium out of the markets because the crop is getting planted, which is pretty normal for this time of year. And we're going to look ahead to weather. And in the next 2 to 3 weeks, it's going to be pretty important for corn, next 5 to 6 weeks for soybeans. Some of the wet areas of the western corn belt that have been really extremely dry are expected to be wet over the next week, 2 to 4 inch rains, which is badly needed because it's dry out in the west, and that dryness is kind of creeping into the Midwest. And then, of course, out east, it's much wetter where they don't need as much rain. But, a lot of places have good moisture, off to a pretty decent start. Now the forecast is what's so critical, and it looks, I think, very favorable for both corn and soybeans.
Okay, now I'm going to throw the wheat in there. 5 sessions lower for Chicago, 5 sessions lower for Kansas City, lower as well for Minneapolis. Cotton market was lower, but really the one that caught my attention, Chicago. The losses there nearly twice as deep as Kansas City's. Where's that pressure coming from?
Yeah, I think there is a little bit of harvest activity that seems to be pressuring the markets. For one thing, getting some harvest, just the fact that the combines are rolling, whether if they're filling up the tanks with grain or not, is putting a little pressure against this market. And I think we really pumped a lot of premium into the wheat of $7. And new crop wheat up to $7.50. We're taking some of that back out here now as there really isn't a need to ration the crop. We're not going to export that much crop anyway. We have enough supplies here that we need to keep prices actually lower to try and chew through this old crop that we have. We're going to carry a lot of it forward this year. We certainly could take another secondary rally, maybe a post-harvest rally. It may come actually sometime in June when the June options go off the board. Maybe that's when we start to see a post-harvest rally. But I think here for the next couple of weeks, we're probably going to be on the defensive for the wheat market, despite a very small crop that is hard to imagine, but that it could get any worse than what it is or get any smaller than already what it is.
All right, we're talking with Brian Hoops. Brian is with Midwest Market Solutions Online, MidwestMarketSolutions.com, back with more Commodity Wrap. It's Commodity Wrap. I'm Tony St. James. Guest today is Brian Hoops. Brian's with Midwest Market Solutions. Let's talk livestock futures. It's been a while, it seems like, since we've had live cattle, feeder cattle, and hogs all moving in the same direction, and I'm talking about the same direction higher. We've had them moving lower altogether, but everything moving higher on Wednesday. What's the catalyst behind this?
Yeah, I think things look fairly decent from a fundamental standpoint for all of the livestock markets right now. From a seasonal standpoint, cattle and hogs usually start moving a little bit higher. We go into the heat of the summer in here. Grills always come out. We start talking about a little bit better demand for grilling season, and that usually gives us a little bit of a rally in here. We note that in the case of cattle, the show list numbers are down sharply again this week, well below 200,000 head, around 194,000 head, telling us that, yeah, that's pretty tight numbers. And these numbers, I think, are going to get tighter here for another 3-4 weeks before they maybe will get a little bit larger. But those tight numbers should give us higher prices. And we're seeing the effects of Memorial Holiday and slow packer slaughter pace. We're seeing box beef move higher. So we're really getting a lot of positive news, positive factors here for this cattle market with higher seasonals, tighter show list numbers. Still look like we have decent demand and higher box beef values. Pork cutouts have been trending higher, except at midday today, but by the closing bell yesterday, they were stronger. So all this is telling us that maybe we're putting in some sort of a little bit of a seasonal low here and are going to try and move our way stronger going into the month of June. So I don't know that you would go back and expect to see new highs or new all-time highs in live cattle or feeder cattle, but maybe go back and retrace some of the losses that we've seen, 50, 62, 78% retracements.
Okay. And then we'll finish up here with the E's. That's energy and equities, which in a roundabout way have really been both of those contributing to some of the gains and losses in our commodity space. Energies, for the most part, lower except for nat gas, moving higher. And then go over to the equities, a little mixed trade there, but we've seen the NASDAQ higher 4 straight sessions, S&P 4 straight sessions higher. What are your thoughts there on the E's?
Well, you look at the equities, first of all, we're hitting new all-time highs yesterday, matching it or coming real close again today. Certainly could see some sort of a correction at any time in these equity markets, but certainly the market wants to be bullish into the summer and into the midterms. It's clearly telling us the lows that we charted in late March, early April, we've far exceeded the previous highs. Just kind of went up to them in 2 weeks and then blew right through them in the last half of April and all of May. We've been stronger. So it's a market that is not fearful of the earnings. I think it's looking forward to earnings of certain companies that continue to come out telling us that AI is in effect, but yet we're very profitable. A lot of these companies are running at peak profitability, pushing earnings higher. It does look like from an energy standpoint, the stock market, well, it's stronger. Crude oil is falling lower here, trading to the lowest level since May the 7th today, taking out yesterday's lows. And it doesn't look like we're going to have a very strong close. We're probably going to be near the lows of the day. I think we're probably getting one step closer to having a deal done between the U.S. and Iran and opening the Strait of Hormuz. And that, of course, that is what everybody's focused on is whether there's a deal ironclad in place or not. If the strait is opened up and oil starts to flow freely, oil prices, energy prices are going to come down. And we had heard there was 25 ships that navigated the strait yesterday without any incident. There'll probably be more here today, tomorrow, and into the weekend.
Okay. Brian, if we want to keep the conversation going, where do we find you?
Well, you can find us online at MidwestMarketSolutions.com, or you can give me a call directly at 417-501-5132. Again,
MidwestMarketSolutions.com. President is Brian Hoops, and this is Commodity Wrap.